Let me start by saying simply from the outset, index funds are great. I'll go into bat for them as the smartest investment move for most people and beginners, especially when the investor has time to be in the market and benefit from compounding. If you're in your 20s, consistently investing in these will pay off handsomely in 30 years. Once you commit to this habit and stick with it in a disciplined manner, you've done everything you need to do to secure your financial future. Of course, you can and probably should, if your heart desires, go further with your wealth creation, but this base level of investment is safe and will be enough to fall back on in 40 years if other endeavors don't work.
You tried your best, and you failed miserably.
So we're going to discuss 5 flaws that ETF investors need to be aware of and can't afford to overlook, even though it's an incredibly good investment vehicle to be engaging with.
You paying attention?
While index funds and ETFs are designed to be ideal investment vehicles because they're low cost, not all are created equal.
I need some honest answers.
Some ETFs justify a higher cost because they're both labor intensive and they generate above average returns. Think of active investment. That takes time, a team, and a strategy, and if they can justify certain rewards, they can definitely justify higher fees. However, you need to ensure the expense ratio is good and one that you're happy with. The expense ratio simply contemplates the amount the manager charges for their service. It is achieved by dividing the fund's operating expenses by the average total dollar value of all assets in the fund. Typically, you like to see around 0.2% for an active investing fund. The sorts of ETFs that I would hold out as being safe investments for the long term, like Vanguard's VOO, have an expense ratio of about 0.03%. However, a quick Google of the worst ETFs for expense ratios right now will show you that dozens are above 2%, with some being as high as 10%. So the difference between a 10% and 0.03 is just phenomenal and really quite scary. These ETFs with high expense ratios simply are not recommended for long-term wealth creation as a beginner.
I think I read Warren Buffett say something like that. No.
Index funds and ETFs are lauded for their diversity and strengths as long-term holds by all sorts of pundits, including me. But this is not actually universally true. The original index fund was exactly that, but with all things in life, as they got popular, new variants began to come onto the market, and some of these are not good. Some of these are highly leveraged, meaning they rely on debt in part to amplify the returns of the underlying basket of securities, which of course poses significantly higher risk.
I really don't think it would work.
There are other higher risk forms of ETFs available which represent other complex and sophisticated strategies, like inverse ETFs, which are designed to hold derivatives which will benefit from a decline in the market or of the underlying index. Think the Big Short of ETFs. These types of index funds do not fulfill the original purpose and the key reason I will always defend the conventional form. They simply don't provide strong and stable long-term returns to help people build financial wealth over their lifetime.
Indestructible.
Because ETFs are traded on an exchange, the market determines the price on any given day, not the value of the underlying basket of securities. This means that it is almost certainly the case that when you buy shares in an ETF, you're paying a price which is higher or lower than the actual value of the aggregate securities held by the fund. However, this price discrepancy is relatively minor and is corrected over time. And also, in reality, not that different to buying shares in a company normally. People do stop and check these numbers, often trying to identify an arbitrage opportunity. The reality is, over time, it's just not an important consideration.
It's an interesting point.
Strictly speaking, a lack of price discovery is not an issue with ETFs directly as much as it is a consequence for the market caused by ETFs. The concept is simple. Because index funds just buy shares in companies of an index and only trade to adjust their positions appropriately for tracking that index, theoretically if there were too many passive investors like this in the market, you would lose the necessary liquidity, that is, shares being bought and sold at a regular pattern, to have an accurate price. As an extreme example, if every share in Apple was held by index funds, there would effectively be no trading of Apple shares, and this would break the market because you'd never have a price set. People love to bring this up, but the reality is, this is a level of illiquidity so extreme that it just really doesn't matter. Currently, there is no practical evidence of this occurring. It's just a really compelling hypothetical and, if I'm being honest, a bit of fear-mongering and clickbait. BlackRock, albeit a biased source, produced a really well-reasoned white paper in 2019 which suggests it's more likely that index funds contribute to price discovery for a number of reasons, such as statistics showing that they rely on tighter and more accurate bid-ask spreads, as well as their capacity to act as shock absorbers to bad news for a company, effectively limiting the market's emotional overreaction to news because an index fund simply won't sell those shares as long as that company remains in the index. I'm actually going to have to do a separate video on this because A, there's a lot to discuss, and B, it's kind of hilarious. There are a lot of examples of market overreactions and the relevance of price discovery which people just need to understand. I see too many people with a platform discussing this who clearly do not understand it, though to be fair, no one really does.
That's the joke.
Tracking an index is a double-edged sword, as you are bound to the market. You're not going to underperform it or outperform it by any real relevant margin. So let's discuss why this can be a problem, other than obviously choosing the security of an index against the potentially higher rewards if you had invested in an individual company. No, you're not going to quickly 10x your investment in 12 months with an index.
Wait.
Come on!
Yeah.
People love to bring up examples of index funds being a bad idea or having downsides. These pundits love to point to the fact that there's been a lost decade in Japan and skew the numbers to suit their argument. People will make sweeping statements purporting to be facts.
No, it's not a fact. It's just what I heard. It's just what I heard.
But let's just have a look at their index, the Nikkei 225, which has been calculated daily since 1950. This is a stock market index for the Tokyo Stock Exchange and where we investors can get access to the Japanese market through an index fund or an ETF. Now let me be clear, it is absolutely true that an index fund tracking the Nikkei did not have a great 20 years and trended down for an entire decade. The index has gone up only nearly 20% from the 4th of January 1991 to now. However, pointing to this, and not thinking further ignores some really critical considerations which we need to dive into, and we'll have to dive deeper in another video, but let's just point out the obvious here for now. First, if you had been dollar cost averaged in this period, you'd actually have done really well and much better than 20%. Second, you would have received distributions for most of this time, so you were actually receiving payments from that fund. This lost decade followed an insanely profitable period of time, so if you had started 10 years prior and invested a sum of money on the 5th of January 1981 when the index was at 7,150 points, you'd have more than tripled your investment in that time alone. Fourth, this decade included the Asian financial crisis, which rocked this market.
That's a lot of information to get in 30 seconds.
None of this changes my conviction that these products are an incredibly good place to start for beginners to secure their financial future.
Oh, I see. Then everything is wrapped up in a neat little package. Really, I mean that. Sorry if it sounded sarcastic.
Thanks for watching to the end, guys. Please hit the like button, subscribe, and comment below for any ideas you have for future videos.